Our next speaker is Mr. Robert Poteat from Oregon, and actually Washington. The city is, what's the name? Onalaska, O-N-A-L-A-S-K-A, Onalaska, Oregon. He's been involved in monetary reform for decades, and was at our conference last year and started up a chapter, actually 3 chapters, on the West Coast, Northwest. The first is in Portland, the second is in Centralia, Washington, and the third is in Seattle, Washington. And things are going well there, and I'm expecting that chapter to really grow. His background in monetary reform is very thorough, and he's very active in anti-war veteran entry war activities. We gave a presentation in, was it May of this year, and we talked to a group that bought some Democratic Party membership there in Centralia, and it was fascinating. They started out just despondent, and everyone was obviously discouraged. And the reason is that the Democrats, as well as the Republicans, buy into the idea of economics, in the sense that it's used as a class warfare tool. And they really believe that you have to have the kind of free markets. I'm putting free in quotation marks, because real free markets, the people who were devising these ideas earlier, required a high level of regulation. The only way to get free markets, in their view, was to have a lot of governmental regulation. Now that's been twisted, and some of our other speakers will talk about that in detail. It's been twisted into the idea that a free market means free of government. Just not true. The last thing. Anyway, as this Democratic group, as they heard more and more, you could just see the pressure falling off of them. 2 of them took the concept of monetary reform onto the state Democratic convention in Washington State, and are going to continue to work on that. So that's an example of what Ken just pointed out, that when you have a commitment, good things can happen when you're out there.
To observe his enthusiasm and energy, so I would like it if we all gave him a big hand for getting us started. Can fractional reserve banking serve public good? Well, the answer is no, so we can spend the next 40 minutes partying. Now, while he was there, I told him about some of my successes in explaining this, so he asked me to come here. I addressed one of my peace groups on the subject one time, explaining the fractional reserve system. I got complimentary comments, and I thought things were going well. But then in a social period afterward, the leader of this group, a sweet grandmotherly type, came over to me and said, they would not lie to us this way. So I hadn't used the word lie or accused anybody of lying, so the implication should be clear. I addressed a group of libertarians one time, a very rude young man stood right up and says, "You're a liar." And what do you do with that? Well, I recovered and I reached in my pocket and pulled out $300 bills. Don't ask me what I was doing with them, but I had them. And I said, here's a $100 bill for anyone who can show me a bona fide, certifiable bank record of a bank deducting your account for the purpose of lending it. And here's another $100 bill for anyone who can show me that a bank refused to pay your check or permit a savings withdrawal because they had lent your money to somebody. And here's a third $100 bill for anyone who can show me a similar record of who got your money. He says, you can't. They don't do it that way. said, that's right, but that's my story, and you have to get another. So realizing he trapped himself, he turned around and sat down, but I don't think I persuaded him of anything. Well, I didn't believe it either the first time I heard about it, but it motivated me to find out. And research never finishes. It always leads from one thing to another, to another, to another. And I came to the conclusion that money and who issues it has dogged human society ever since it began. And the theories ginned up by people to support some kind of ideology or belief system of how it all began is simply nothing more than imaginary speculation. We don't really know yet how it began, but what you see up here is a cuneiform tablet, 2,500 years old. Some of them in this collection were 4,000 years old, but I picked this one because it was a good thing too, with the light we have in here. It showed up a little better. Now, there seems to be two major threads of controversy in monetary history. One is what money is made of, and the other is who issues it. And as far as I'm concerned, the abstract money system has built the greatest economy the world has ever seen, so it wins that controversy hands down. There doesn't need to be any more discussion, I think, of what money is made of. And to those who still argue for gold or some other commodity, all I can say is, you must be kidding. Who issues the money is really the crux of our reform. And our credit money system, while building this great economy, is also the greatest con game in history. Peter Cook of Monetary Science Publishing called it a scientific slavery mechanism. And credit money is doublespeak because credit on one side of the ledger is debt on the other. Guess who's in debt? You are, we are. So how then does this come about? Who issues money, why, and what are the effects? This is our money, everything you're familiar with. Coins which are minted and spent into circulation by the federal government. The Federal Reserve note, which is not a note at all because it promises to pay nothing. It's just a debt note backed by Treasury securities. Whatever was Congress drinking when they did that? I would like to know to make sure I don't get it. Coins and Federal Reserve notes, however, account for very little of our transactional economy. And what really counts is the other three devices you see there, a checkbook, a credit card, and a debit card. And these are just devices for moving numbers from one account to another. And that's all money of this kind is, just numbers. Where do the numbers come from? They're created by the Federal Reserve banking system. This is a bare bones organizational chart of the Federal Reserve System. The Board of Governors, consisting of 7 men, including a chairman, appointed by the President of the United States with advice and consent of the Senate. The Open Market Committee, which is 12 men, includes the Board of Governors and 5 presidents of Federal Reserve banks with voting power. However, all the presidents do attend policy meetings. There's the 12 regional Federal Reserve banks and the member banks. The Board of Governors has monetary policy authority in the United States. They control the amount of money, interest rates, and they supervise the entire banking system. The Open Market Committee, in conjunction with the Board of Governors, determines and acts on that policy and the 12 regional Federal Reserve banks acting in the open market take the necessary actions to do what is necessary. This is a chart of monetary policy as regards the monetary supply. The objective is set between 4 and 8%, and the black line is the actual achievement during that period. It's the member banks where most of our money is created. The member banks are ordinary banks where you might have your checking account, your home mortgage, or whatever it is that you do with private banks. The private banks, member banks, create money by lending reserves provided by the Federal Reserve banks. Now, you have heard over and over and over, and I know you have because I have, that banks make their money by paying lower rates of interest for deposits than they charge for loans. There was a time when that was true of certain institutions, but it's one of the things now that everybody knows that just is not so. I think Will Rogers said that economists know more that ain't so than anybody, but there are things that we know that ain't so too, and this is one of them. This is how modern money mechanics explains it. Of course, they, meaning banks, do not really pay out loans from the money they receive as deposits. If they did this, no additional money would be created. What they do when they make loans is to accept promissory notes in exchange for credits to borrowers' transaction accounts. And this is our money just created by numbers. They're just numbers entered into transactional accounts. Steve already showed you this. This is an explanation of how they do it. It assumes an initial purchase of a $10,000 Treasury security and a 10% reserve requirement. Now, when the Federal Reserve buys a Treasury security, it does this from a private dealer, and it pays for it simply by either, say, a check or a computer transfer. Anyway, a credit to the dealer's transaction account. And at the same time that it credits the dealer with the $10,000, it credits the dealer's bank with a $10,000 reserve. So if we start then with this, everybody see that? $10,000 initial purchase, then a credit is made in the dealer's account here. At the same time, a $10,000 reserve is credited to the dealer's bank. Now, once they have this $10,000 reserve, assuming the 10% reserve requirement, they're enabled to make a $9,000 loan. We add this $9,000 loan to the already $10,000 deposit paid by the Federal Reserve, we have then a total of $19,000 in new creation. But this $9,000 that's created by the bank as a loan will be deposited somewhere in another bank. And that bank is credited with $9,000 in reserves, 90% loan of that, $8,100. add it on here. And as it adds up, you get $27,100. And as this process continues, then the entire creation is theoretically $100,000. The private commercial banks creating $9,000. Now this is called fractional reserve lending, as you've already heard. This is another way of looking at it. This is just the data from which the graph was made. Now this is right straight out of Modern Money Mechanics. It was first published by the Federal Reserve Bank of Chicago in 1961. And it has been revised. This is the 1992 revision. It is now out of print, but I will give you a URL where you can download it later. This is also described in a booklet published in 1939 by the Board of Governors. Now, this is not an original, it's a preservation, but it described in the same kind of words that I've been using here without the beauty of the graphs, but of the system. So the information has been around for a long, long time, but as I related in my personal anecdotes, there's just a lot of people that don't believe it. Now, Mr. Galber said, the way banks create money is so simple it repels the mind. So if I'm repelling your mind, you're probably getting it. The rest of the story is that when loans are paid back, the money is canceled out of existence. And the banks then are left with excess reserves ready to make another loan. If the Federal Reserve wanted to decrease bank reserves instead of increasing, it would sell securities back into the market. In that case, it debits the dealer's transaction account, it debits the bank's reserve account, and that whole buildup that we saw in the graph then has to be collapsed. And this is one of the ways they regulate the money supply by changing the reserves. What you hear about mostly in the media is their changing of interest rates, which is supposed to encourage or discourage lending. And then another way would be to change the fractional reserve ratio. Now, what this indicates is that except for the little bit of money that the government creates by coins, all of our money is created out of thin air or by bookkeeping entry by an essentially private system. The Federal Reserve Board of Governors, of course, is appointed by the president, but the Congress, which has the constitutional authority over money, is simply acquiesced to this. And essentially all of our money, with the exception of coins, is privately created, and it is created as debt. Now, I told you before you were in debt. This is the growth of gross public treasury debt from 1981 to 2006. It took until 1981 to accumulate $1 trillion of public debt. And since then, it has multiplied 8.5 times. It's a little over 8.5 trillion as we speak. It is simply unconscionable to me that the government would put this kind of debt on us when it has the power to create its own money. If a bank can create money, a government can create money. And it's so simple. Galbraith was right. It's so simple it repels the mind. China is said to be holding about 1 trillion of this. So that DVD player that you bought that was made in China, you're still paying for it. And you will be paying for it for a long time. Collectively, we're sending them $30 or $40 billion a year, whatever the interest rate on those securities is. Another way to look at it is based on 300 million people. Each one of us owes about $28,000. But don't worry. You will never be required to pay it. What you will be required to pay is the interest on it, about $1,000 each per year, forever. Now, does this kind of system serve the public good? Where does the interest go? Well, it goes to rich people and institutions that buy U.S. Treasury securities. We're in a position now where the top 10% of the people own about as much as the lower 90% put together, and about 1% going for half the nation's wealth. Constitution gives Congress the full power to create money, and it has created money to some extent, mostly throughout history, and still does with coins. So the idea of the government not having the authority to do it is a non-starter. This nearly 8.5 trillions, or it's more than 8.5 trillions now, of privately created money the government borrowed, it could have created itself. It simply handed over its seigniorage to the private banks. What were they drinking? I don't want any of it. The Treasury charges the Federal Reserve banks about 3 or 4 cents to print a Federal Reserve note. If it printed its own U.S. notes, which are still legal tender but not circulated, the seigniorage would be 96 or 97 cents on a $1 bill, and even more on 5s, 10s, 50s, and 100s. And bookkeeping interest would be even more efficient. And it's all unnecessary, and in my opinion, criminal, even though it's legalized. So, can fractional reserve banking serve the public good? Based on a nominal 8.5% growth rate over the last 25 years, this is where it's going. In 25 years, it'll be nearly $70 trillion. Now, 20 years or so ago, when I was telling people where it would be today, they told me I was nuts. Oh, it can't happen, Bob. What are you talking about? Ken Bonsack already stole my line, but to believe that this will not happen is to believe you can do the same thing and get a different result, and that is what is nuts. Your share will increase from $28,000 to about $225,000. And the interest will be about $8,000 each annually. This is credit market debt outstanding. It was $5 trillion in 1985, $45 trillion now. Embedded in this is state and local debt, which Ken Bonsack talked about. 1.87 trillion additionally. Again, the government could have issued money directly to communities, as Bonsack suggested, either by grants or interest-free loans, but they didn't. Local entities borrow the same bank-created debt money, putting us more and more in debt with a deeper and deeper interest load. And some of these infrastructure projects, by virtue of interest on bonds and fees that bonds I've talked about, can cost 3 times the construction cost. Why did we put up with it? Does this serve the public good? 2 trillion of consumer debt included in this. We are debt slaves, and who benefits? Well, it's privileged financiers. The upper 1% claiming about half the national wealth, while on the other end of the scale, you know what's going on. Lack of safe housing, food, and medical care, and it's all, the cost of all this being laid back on the taxpayer, but also in the accumulating debt, which just goes on and on. Poverty and desperation lead to crime. Police and prisons are major growth industries. More of the same, accumulating burden on the taxpayer and accumulating wealth. The ownership of the wealth includes our information system. This is one of the funniest cartoons I've seen in a while. This was published in Forbes magazine with an article under the name of Steve Forbes. Studious Ben and serious Hank, and he wants to convince you that this banality is what they think about. It's already been covered, banks like to lend on real estate. This creates housing bubbles. It also leads to paving farmland while our food supplies are dwindling. Ben Deason will fill you in on that. In my county, there's a big squabble over land management. The developers want to pave the land for houses and malls because banks will lend on it. Large amounts of money are put into Wall Street speculation and gambling, leading to what I call historical imputation of value of stocks, bonds, derivative gambling, futures. And this enables some people to gain inordinate amounts of claims on the community as well. If there's anything bankers like to finance more than real estate, it's government, as we've already seen. Government, with its police power and power to tax, is a safe investment. During the Great Depression in the 30s, inestimable human suffering was allowed to happen until war production started. Suddenly, there's all the money needed to waste on war. The current misadventure in Iraq will cost at least $1 trillion by the time the interest is added up, and they want more war. The rationale for establishing the Federal Reserve System was to end the boom and bust cycle with the elastic currency. What a joke that turned out to be. The Fed crashed the economy in 20 and 29 and has continued with recessions on approximately 10-year intervals ever since, and they're doing it again. Does this serve the public good? Human infrastructure, such as education and health care, are in similar deficit. Last year, we were shown a $1.6 trillion deficit in infrastructure repairs before the hurricanes. Bottom line, corporate accounting is a driving force against the environment. Costs of environmental management are externalized by unassessed environmental damage. In other words, just throw the pollution out there. and then money costs to the taxpayers for cleanup through the EPA when done. And that does not measure the human health effects of the pollution. The extreme stratification of wealth reduces the idea of democracy to a forgotten word in the dictionary. Do I have to tell you who or what is running things today? As you've already heard, the handling of the hurricane damage of 2005 was a travesty. Could have and should have been prevented, but our government has abandoned its duty to the people. This was written in 1935 when there was so much opportunity and pain. They, meaning bankers, viewed the national interest from the windows of the bank parlor. From their point of view, industry, commerce, agriculture, wages, employment were the counters and skill game of international finance. They must be regulated to fit in with the monetary scheme. The monetary scheme must not be regulated to meet the necessities needs of the world. Now, in psychiatry, this kind of callous disregard of others is considered to be a symptom of psychopathic disorder. Does that serve the public good? Our government simply does not have control over what money is issued for. It is issued by private bankers, and bankers profit from the interest. Now, I've been on a negative rant, and that's not a good way to start out a convention, right? So we've got to turn this over and look at the opportunities we have. I went to a boss one time and I said, "Hey Russ, we got a problem." He looked at me and says, "No, Bob, there are no problems. There are only opportunities." So take back our money system and we can go to work to solve every one of these opportunities I've talked about and more. We can have a society of peace, compassion, sufficiency, and a clean environment. Now, wouldn't that be a great satisfaction? It is our challenge to do that, and that's why I'm here. Thank you.
I'm from another country, and in my country we have a central bank, have had since 1935 when our Prime Minister long term ran on that ticket. His name was William Ryan Mackenzie King.
Oh, yeah.
But we're worse off than you. I've just calculated our national debt, $500 trillion, 30 million people. That's 17K per year per person. But we're paying twice the interest rate that you are. We're paying 7%, so it's $36 billion a year that doesn't go into public goods and services. And that $500 billion, we've done the calculation, that's over 90% compound interest. I think that's a useful statistic for you to be calculating on the U.S. national debt.
Yeah. Well, you're absolutely right about this. Everyone that I have corresponded with in Canada and New Zealand and Australia and in some cases Great Britain, it's the same everywhere. It's the same system. And I talked to a Canadian about a month ago, and he confirmed that Canadian banks no longer use this fractional reserve system. What I was talking about. These are URLs that I promise you. So the trend is that way here. They're trying to move away from this. That's why they've taken this explanation out of the literature, I think. And the first real tranche of the required reserves is 0%. And then the next tranche is 3%, and then it goes to 10%. So they're putting more and more of the money creation right into the commercial banking interest, trying to completely isolate it from government.
We're not doing 100%, but we're doing 90-some% of money creation currently. And you must know that a little over 10 years ago, our Prime Minister, whose name was Brian Mulroney, who's still pulling strings behind the scenes, he saw to it that the banks no longer had any reserve requirements.
Right.
It took 3 years, so now we have none.
Right.
Just imagine what I, a banker, if I were, could do with global derivatives, some of which have done. And there's a piece in here about Citigroup and Merrill Lynch being hit with $2.5 billion over the Enron fraud. That's small potatoes. One bank in Canada had to pay up twice that. And the other thing I read in the paper today is that there's a study done of US and Canadian universities, and it says 56% of the business guys at Harvard Business School and that type of, the people that spawned Jeffrey Skilling at Enron, they cheat. That's news, apparently.
What that example showed, of course, is just an example. And as far as transactional money is concerned, the banks are creating far more than 90% of it, far more. I mean, I don't have any good figures on how much more, but the only thing the government creates is just a coinage, and what does that amount to? And it amounts to nothing when you're talking about trillions of dollars that are being shipped back and forth by computer transactions around the world. It's nothing. So probably as far as transactional money is concerned, it's probably in the high 90s.
Could you please explain the counter argument that most people would have to say if the government prints its own money, it will create inflation? It's off the slide that you had up there, but the average person has been programmed through the public education system that when the government prints money, it creates inflation, and there's a cost associated with that.
Yeah.
So if we didn't borrow the $8 trillion and the government printed it, well, that would cause inflation. What's the counter argument?
Well, the counter argument is that the proposal is false based on history and what the government has done in the past. But if you take the quantity theory of money as related to inflation and look at that, there are a couple of places in history where I think that happened when the Europeans were plundering the Americas and hauling boatloads of gold and silver back to Europe, and also during World War II. I was just a kid, but I know we had rationing and an Office of Price Administration and so forth. But a dollar, based on the quantity theory, issued by a bank or issued by the government would have no different effect as far as quantity theory is concerned. But when a bank issues a dollar, it doesn't issue a dollar, it issues $1.10 of debt. And so that system in and of itself is inherently and unavoidably inflationary because of the necessity to lend more money into circulation so that the interest can be paid and the whole thing can keep spinning. That's why you have these exponential curves that I showed you. And the projection I made there is not a prediction, it's a projection, and it will happen unless we do something different. And with this exponential growth of debt, if they did not inflate the price of the assets, the whole thing would collapse. So the monetary system, despite all the propaganda and brainwash, like that cartoon from Forbes I showed you, we have an inherently inflationary system. And it's unavoidable.
So I guess it's kind of a question with the balance sheet of the country showing this debt versus the argument with like M1 money supply and how those two interrelate. But your point is well taken that if the government printed it, it would be $1 borrowing from the bank, it's $1.10 or whatever the interest rate is.
Right.
But how would that be expressed again on the balance sheets and with the money supply?
Well, it isn't expressed in any statistical way that I know about. I mean, you could probably dump it out from bank statistics. But even if you issue more money, it depends on what you issue it for. If you issue it for something where you get goods and services in return, it's not necessarily inflationary. I mean, you can take an example where, say, a business borrowed money to upgrade its equipment, it could actually end up lowering its prices in the market. So when you talk about inflation, it's a little bit like Mark Twain said. He said, arguments start when people use the same word to mean different things or different words to mean the same thing. So when you try to define inflation, everybody has such a vague idea of what it is that we get lost in what it really means. It generally seems to mean price increases, but on the other hand, we gain efficiencies, and prices are affected by so many things like seasons and cost and whatever else is going on. And the idea of raising interest rates to curb inflation is what? I mean, it's going to raise the cost of doing business. How can it curb inflation? So there's just a whole world of semantics and philosophy that get involved here when you even try to talk about it. But it's a question that comes up because it has been so inculcated into our consciousness. Oh my God, if the government creates money, it's inflationary. And that's the bank's successful propaganda, really. It's all that is.
To me, this seems that the concept of money is actually being replaced with the concept of credit. One of Akers' interviewees a while back, and Ann Dion, brought up the concept of the toilet paper economy. And to me, this is kind of what seems to be going on now.
Give her the mic, Steve.
You just mentioned, we have a coffee break ready outside, so as soon as your question period's over, we'll go out into the next room there.
I forgot to start the stopwatch, so I don't know where I am on time. How are we on time? The time's over. It's over. It's over. Well, give her a chance.
You said the first tranche is 0%. I didn't understand that. They have the option of setting no reserves and letting banks create all the money they want.
Well, it's determined by tranches. It's bad terminology to slice. The first 7.8 million in deposits, no reserve are required on the loan. Zero reserve. So in theory, it's an infinite money machine. The next tranche is 48 million, and it's 3% on that, which means they can multiply it by 33 times. And then above 48 million is 10%. Okay, coffee.